Welcome to today's Explainer. We're diving right into how modern financial giants, and we're talking everybody from century-old legacy banks to scrappy crypto startups, are aggressively rewriting the rules of the industry. Because, as it turns out, simply sharing the revenue just isn't enough anymore. Nowadays, everyone wants to own the game.
So right now, half of Wall Street is completely glued to Amazon and Microsoft guidance. It's the absolute busiest stretch of the Q2 earnings season, plus it's a massive Fed rate week. But while everyone else is fixated on those mainstream macroeconomic headlines, the most fascinating structural shifts are quietly happening over in fintech. We've got a news cycle that simply refuses to sleep, playing out right under our noses.
Here is our agenda for today. First, a wild week in fintech. Second, HSBC gets paid twice. Third, Flex wants its own bank. Fourth, BitMine corners Ethereum. And fifth, the big picture takeaways.
All right, kicking things off with Section 1, a wild week in fintech.
Look, the core shift driving the market right now is basically this. Whether you're a legacy institution that's literally been around for over a century or a scrappy new software startup, the era of the happy middleman is totally over. Companies are rewriting the rules to maximize their own margins, and they want to keep the entire paycheck.
Moving right along to Section 2, HSBC gets paid twice.
Okay, so HSBC just sold its Singapore life and health insurance arm to Allianz for roughly $2.2 billion. Now, pending sign-off from Singapore's central bank, this deal is expected to close in the first half of 2027. And when it finally does, HSBC expects to book a massive $1.8 billion pre-tax gain. But the crazy thing is, that sale price is really only half of the story here.
This move is honestly a masterclass in strategy. Before this deal, HSBC owned the risk of actually operating the insurance business themselves. But after the deal, they're essentially just leasing out the distribution. They signed a 15-year exclusive distribution agreement where Allianz is going to sell insurance, retirement, and wealth products directly to HSBC's Singapore customers. So HSBC gets the heavy capital off its balance sheet, they get a cool $200 million upfront cash payment once it's live, and they still pocket a cut every single time a Singapore customer buys an Allianz policy for the next 15 years. They effectively found a genius way to sell the business and keep getting paid for it.
It is literally the banking equivalent of selling your car and then leasing it right back. And for Allianz, the strategy makes total sense too. They get instant access to a massive, established customer base without having to spend the time and money building that distribution from scratch. It's exactly like buying concert tickets from a scalper instead of camping outside the box office. Sure, you pay a premium up front, but you walk right in.
Now, let's jump to Section 3. Flex wants its own bank.
So Flex is a rent financing startup, and they've already processed an incredible $40 billion in rent, which has helped their users avoid hundreds of millions in late fees. Up until now, they've just routed everything through their sponsor partners, Lead Bank and Column Bank. But after proving their massive scale, Flex is looking at those partners and asking a very direct, very important question. Why am I splitting the pie on a product that we built and scaled all by ourselves?
And Flex's move here isn't just a one-off. It is part of a massive boom. Upstart just landed conditional approval for a national bank. SoFi has already made the jump. Mission Lane is waiting in the queue, and now Flex is officially applying for its own charter in Utah. The irony here is pretty amazing, right? The fintechs that were built specifically to disrupt the big banks are now realizing they basically need to become one to control their own destiny.
The math is simple. By transforming from a software company that just routes transactions into a fully FDIC-insured bank that originates them directly, you cut out the middleman entirely and keep significantly more margin. But there is a massive catch. Running an insured, heavily regulated bank is an entirely different beast than just writing code for a software platform. Flex's leadership is making a huge bet that their team can actually handle both sides of that equation to capture that extra cash.
All right, Section 4. BitMine corners the Ethereum market.
Over in the crypto world, publicly traded BitMine recently disclosed in an SEC filing that its combined holdings have hit $11.8 billion. But what actually anchors that number is absolutely wild. They currently hold 5.79 million ETH. That single stash represents 4.8% of the entire global supply of Ethereum. And they're rapidly closing in on their stated goal to own a full 5% of all ETH within 12 months. Just think about that for a second. A single publicly traded company trying to own 5% of a major global cryptocurrency. No way, right?
Well, they are doing this through an incredibly aggressive dual strategy. Under a $4 billion program, they have repurchased 11.6 million of their own shares since July 1st, making it the largest buyback ever by a crypto treasury company. Second, they're buying a massive chunk of Ethereum at the exact same time. It is essentially the crypto version of a massive short squeeze. They are dramatically constricting supply by simultaneously vacuuming up both their own stock and the underlying asset.
But here is the kicker. They aren't just letting that Ethereum sit in a digital vault gathering digital dust. Of their total holdings, they have staked nearly 5 million ETH through their own validator platform, which is called Maven. By doing this, they are projecting a staggering $254 million in annualized staking rewards. Just let that number sink in for a moment.
It's like putting a savings account on steroids. They aren't just passively holding cryptocurrency anymore, crossing their fingers and hoping the line goes up. They are turning their corporate treasury into an active, massive passive income stream. BitMine is effectively acting as Ethereum's landlord, cornering a chunk of the market so big it is literally enough to make central bankers nervous.
Bringing it all together now with Section 5, the big picture takeaways.
So whether you are a legacy institution divesting an insurance arm in Singapore, a rent startup demanding a bank charter in Utah, or a crypto company vacuuming up Ethereum, the underlying motivation is exactly the same. Stop paying the middleman, own the infrastructure yourself, and keep the profits. Make no mistake, the institutions that control the distribution and the regulatory structure are the ones who are going to win the next decade.
This relentless drive for margins isn't just a high-level corporate strategy. It is absolutely going to rewrite the rules of the apps and services you use every single day. If every app on your phone eventually becomes its own bank and every legacy institution starts acting like a tech platform, how does that change where you actually trust your money? It is a massive shift, and for sure one we will be keeping a very close eye on. Thanks so much for joining me on this explainer, and I'll see you next time.